Well, let's get the opinion of the chart master, Carter Braxton Worth. What is history pointing to for the markets in the second half? Carter, what are you looking at?
Well, it's pointing to gold, that's for sure, and BK's, I think, dead right on that. But let's talk about the market. So first slide of 4. What happens when you're in a calendar year at the midpoint and you're down? I mean, it's something to look at, meaning it's fairly rare. If you look at all instances, the history of the data, you can see there the market at the midpoint, June 30, has been down 33 years in its 92-year history, 1928 to present. So the odds of being down are lower than the odds of being up. Markets are built to go up. And so you see the odds there, 35%. Next slide. So the question is, what happens in years when you've had an inauspicious first half? And you see the data here. Second half performance in years where at the June 30 point, the midpoint, you're down, the average return for the whole year is 0.71%, meaning the second half performance, excuse me, and you see the median is 1.34. Those are very muted numbers. Now, it doesn't have to be the median or mean. It could be better, and it could be a lot worse. But the point is, an inauspicious start usually means not the best in terms of what comes in the second half. 2 charts on the S&P. Next slide, next chart. So take a look. It's the same one we've been looking at together night after night. We know our high is 3,400. We know our low is 2,200. We know we crashed, we ricocheted, and we basically are sort of churning now. But the key to the churn is this: do we get down to that 2,800? Do we retrace 50%? I think we do. Last chart. And so here you see the same chart as on the last slide, but I've drawn the trend line. This is the simple trend line that's been in effect since the March low. So the market has tracked this line quite precisely, and now it is broken. The presumption is that the break is not over and that there's more to go. I'm in the camp that we go to 2,800 and we figure it out from there.
All right. Carter, thank you. Carter Braxton Worth of Cornerstone Research. We will see you a little bit later on OA. Let's trade this, and we'll go to the general for this. I mean, in terms of using history as your guide, Jeff, it seems like the risk-reward just may not be there for 0.74% on average and a median of 1.34% upside.
I mean, that's certainly the camp that I've been in, right? And I think, to BK's point earlier, it's a little bit hard to determine which direction the market's going to go just because this tug of war is going on, right? You have policy support, economic data probably gets incrementally better from here, but then you have all of these issues in the second half of the year, not the least of which is the election. And I think we're going to start talking about that more and more. And in terms of using history as our guide, typically presidents do not fare so well when they've experienced a recession in the 2 years leading up to their reelection bid. I think Calvin Coolidge was the only president to be reelected when experiencing a recession in those previous 2 years. So in terms of the market trying to game who's going to win the election, what that means for the corporate tax rate, things of that nature, I think there's a lot of headwinds in the second half of the year. So I'm leaning toward risk versus reward.
I feel like we have to change his nickname to the professor instead of the general. I mean, pulling out Calvin Coolidge, I think that's a first in fast money history. Yes, the more you know.